this whole event with Silicon Valley and Signature and First Republic has, I think, given rise to a lot of people rethinking what their cash should be doing, where they could earn a higher yield. And in today's sort of modern banking era, it's extraordinarily easy to open an account online, move money, and it could be moving money within the banking system. You could be moving it from a savings account that pays you next to nothing to a high yield online savings account that might pay you 3 to 4%. Or it could be moving money out of the banking system altogether into the money market system. So where yields obviously are much higher. And so that is going to represent a cost of doing business for the banks more broadly. In other words, they're collectively going to have to raise the rates they pay on deposits. So all of this is going to compress profitability on the NII side. And then on top of all that, the natural response, as we went through on the deck and as we've talked about, is that there's going to be tighter, stricter underwriting in the wake of all this. That too is going to put pressure on the loan side of the business. So, just kind of like I guess a bit of a cautionary set of comments that, changes are coming to the banking industry. This is not just going to be sort of like a tempest in a teapot where, things blow over after a little while. I'm not even talking about the credit cycle. I'm talking about the specific fallout to this particular event from the longer term return on capital standpoint. So capital requirements are going to go up, returns are going to go down. So basically the industry has been structurally impaired. So even though it seems quite cheap in conventional metrics on a year-to-date basis, it's not quite as cheap as it looks for that reason. So I kind of wanted to run through that.
You just gave people more information that they're going to get that is actually tangible, useful, practical in 4 months at CNBC, listening to CNBC. And this is, when we talk about 100%, we talk a lot about probability because our whole process is based on the acceleration and deceleration of numbers that affect the probability up or down in things that you could buy or sell. It's rare that you have 100% probability in anything, but there is a 100% probability that the credit tightening component of the credit event that we talked about, starting, for our, phase 3, the bear market credit event, which we started making that call in January. There's 100% chance based on what Steiner said that everything is tighter than what it would have been if those things didn't happen to those banks. Okay, so that's what makes us incrementally more bearish, asking ourselves, are we bearish enough?
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.